Hey guys, welcome to the second episode of this new series with Softlogic Stockbrokers, where we help you learn technical analysis from the beginning. So let's get started. In our previous episode, we touched on a lot of things on the basics of technical analysis and where and how this research method, this analysis method has emerged, right? Just to touch on where we left it off, right? As mentioned earlier, technical analysis is the methodology to forecast future price action based on the study of past price action. And when I say past price action, it's basically studying how price is developing in a chart and also taking into consideration volume and some other factors. And as mentioned earlier in the previous episode, if you haven't checked the previous episode, please do. It's very informative. There are a couple of things that we take as assumptions to make sure that we are in line with years and years of decades and decades of research. Some of the other key principles that we take into consideration is there are some accepted assumptions in the field, as shown in the screen, right, where the first one is buy the rumor, sell the news. Because as mentioned, because a lot of markets are driven through sentiment, human sentiment, because all investors, whether small or big, still trade based on not only information that they get, they also focus on their emotions, and that gives a lot more precedence to the fluctuations that we see in the market right now. And the topic of buy the rumor, sell the news comes from asymmetric information, where a lot of these ways that we consider, or a lot of these larger investors tend to have more information on their end, and they tend to exit out of the market, or they tend to get out of the market when you least expect it, where they have high information and the smaller investors get stuck running behind a certain hype or rumor, that they become the scapegoat for some of these sell-offs. And with the use of technical analysis, we can reduce the risk of you getting caught into some of these things. And also, another part of buy the rumor, sell the news is associated with a lot of people, as mentioned earlier, because a lot of the news and price action news is absorbed by price action, or a lot of the news is included in price action when the rumors start to happen, and then after a couple of weeks later, when the actual news comes out, right, there is a kind of a cascade of selling, because the rumor or the actual news is priced into the chart already. So that is a key principle to keep in mind, where if you are dealing with rumors while you're analyzing a certain stock or counter, make sure that you are not on the wrong side of the market, where you just go follow your emotions without a rigorous technical approach, and you might get stuck on a side where you don't want to be stuck on. And the second thing and the third thing are kind of a combination, where the trend is your friend, don't fight the tape. Tape here, meaning trend itself, is, as technical analysts, you need to identify trends that are happening in a certain counter, whether it's a short-term trend, mid-term trend, long-term trend. And based on the trend type and based on the type of investor you are, whether you're a short-term investor, long-term investor, or mid-term investor, analyzing and understanding the trend will help you be on the proper side of the market and help you maximize your gains, reduce your risks, and make sure that your portfolio has sustainable growth alongside your trading journey or your investment journey. So make sure, with the lessons that we continue, make sure that you understand how to identify a trend, whether it's a short-term trend or a long-term trend, And based on the trend that you're doing, or whether you're a short-term trader, if you're a short-term trader, you might need to know, okay, what is the short-term trend right now? And based on that, you can easily act on a short-term trade. But to keep in mind that always the bigger trends impact the short-term trend. So if you are a short-term trader who wants to, for example, take a buy position in a counter, and the long-term trend is actually bearish, make sure you know what you're doing, and make sure you are following rigorous risk management principles, because since the long-term trend is bearish, for example, that trend has more impact on price than the short-term upward trend, which would maybe last for a couple of days. So make sure, if you are trying to get into a position, make sure you're not just looking at a short-term trend, but also the long-term trend, so that you can make the trend your ally, so that you don't get again stuck in an unnecessary situation that you would need to that you might need to get out of. Understanding price action. Right now here, I have taken an easy example of access engineering. Price action itself is controlled by demand and supply, right? If there is demand, there has to be supply, and both have to work in synergy for a counter to pass hands. If I'm a buyer and you are a seller, you need to make sure that you are selling your quantity for me to buy your quantity. If there's only buyers, there still won't be any price action happening in the market, because there's no one selling to you. So that relationship has to be understood thoroughly, because it's very important in your trading journey. And this is just a quick example of a live screenshot of AEL, right? And as you can see right here, right, in June of this year, we have seen a tremendous growth in price action, where we had gone from like 37.5 to 61, or almost 62 level. And what influences this is not part of this lesson. Obviously, there's so many drivers to influence such a price action, but the underlying factor is that there's demand for the counter, which is more than the sell pressure for the counter, and that's why price is able to be pushed higher and higher, because there's much more demand for the counter than sell pressure currently on the trading book. And it can be turned the other way also, where you might see there's a lot more sell pressure for the counter, where in that case there's a lot more people trying, or investors trying to sell the counter, than buyers are trying to buy. And that just cascades down price into a negative price action, where you see price coming down further and further. And the when you look at the order book, you might see, okay, if you see that there is a lot more buyers than a lot more sellers, you might expect as a hint that, okay, buyers are willing to buy the count up, and they are bidding, which is the bid ask spread. The bid ask spread is where if I'm a buyer, I bid for the counter, and if I'm a seller, I ask for a certain price to sell my counter, and that is the bid ask spread. And the more demand there is, the more bidding there is, and if there is higher demand, as mentioned, price and more eager investors to buy the counter up, they will be bidding higher and higher. And that's how this type of upward price action happens consistently, where with sentiment coming into action, means emotions coming into action, people want to get into the counter as quick as possible. So they're asking the counter at higher prices, so that they can get in technically early, and witness a price gain. So in general, understanding price action comes to a basic principle of knowing what supply and demand is, and knowing that for price to move at least even a cent, there needs to be buyers and sellers on both ends for the counter to change hands. And I think, talking about price action, the biggest thing in technical analysis is different types of charts. Right now in CSC, we are using candlestick charts, but earlier down the day, and still one of the particular methods or one of the charting methods is line charts. It's a very simple chart showing the closing price of each interval. To give you an idea, an interval can be cut down into, it can be a day, it can be 5 minutes, it can be 4 hours, it can be a week, it can be a month. But based on the time frame that you choose, line charts will give you a simple chart that helps you identify the longer trend, because it just maps the closing price, and the closing price is very important for us because we know that this is compared to wherever the counter would go within a certain day. The closing price is very important to us as a technical analyst, because that's where the day ends with both buyers and sellers agreeing. And as mentioned, line charts can be very useful and helpful in your journey, where if you want to identify an overall trend without the multiple analysis, and you just need to identify the trend in a simple glance, line charts would come in very handy. Bar charts were primarily used in the US. But while we will talk about candlestick charts, which is the most used charting type right now, or chart type right now, candlestick charts, which we will get onto here, right, came from Asia or Japan on that side of the market. And as a similar approach, bar charts were made on the US side of things, or on the Western market, where it's the same concept of the candlestick charts, but I think as people have come to realization, candlestick charts are a bit more easier and visually easy to understand. But as a charting type, bar charts and candlestick charts only differ from their body type visualization right here. And for example, the candlestick charts have 4 important points in them: the body, the wick, the opening price, and the closing price. As you can see in this very small example, let's take this last green candle for example. When a candle becomes green, that means the close is higher the day, whatever time frame it is. As you may know, every chart can be broken into a certain time frame, whether it would be 5 minutes, 10 minutes, 1 day, 2 hours, whatever you prefer, right? And if you consider that this is a daily time frame and daily chart, one candle would represent 1 day. And if it's a 1 hour chart, one candle would represent 1 hour. Whatever time frame that is, each candle has the same characteristics, where if you are seeing a green candle, that means within that 1 hour or 1 day time frame, the close of the counter is higher than the open of the counter. And the open of the counter is shown by the lower part of the body, which is like this rectangle part, and the close of the day is shown by the top of the body. So if in the certain time frame you have a green candle, that means for example on a daily candle, right, you open the day and close it much more higher. And these two wicks are also important, where they mentioned, yeah, within the day you went much more higher, but there was some sell pressure and you came down and closed at this level. And the low wick can be taken as okay, within the day price went lower than the open, but demand came in and price got bought up, where it went lower than the opening of that certain time frame, but the counter was able to close at a higher price than the open price. So the wicks in itself are also very important to us, because they contain a lot of information that technical analysts can dive deep into, and wicks give us a lot more hints on what could come in the future days if you learn how to understand them properly. The most easiest thing, when I say the most easiest thing, The act of drawing a trend line is very, very easy. But the hardest part of drawing a trend line is knowing where and how to draw a trend line, right? Whatever charting types you use, right, it is very important for you to understand where and how a trend line can be drawn, right? And as we mentioned, and as I mentioned on the screen, right, we will dive into exactly how to draw trend lines on a later episode. But right now, you need to understand the basics of how to draw trend lines and some steps that you can identify. The first step is identifying whether the trend is up or down, right? Right now, if you take a glance off from a certain counter, let's go back to our first example, right? AEM. When you take a look at it from a daily time frame, you know that the trend is up, right? So you probably want to draw trend lines, and these trend lines can be drawn on two different ways, which I'll get into. But you probably want to take a glance, look at, okay, where is the counter heading? Is the counter currently moving up? Is the counter currently moving down? Or is it moving sideways? And based on that, then you can start to plot your trend lines to identify support and resistance levels, right? And for a trend line to be made, there needs to be a minimum of two touch points or with price. So if you're drawing a trend line, there has to be at least two places where price is touching that trend line for that trend line to be valid. And something also to keep in mind is this will talk in just a bit, where when we come to identifying support and resistance levels is when you draw a trend line, the more and more touches a trend line could get. And the trend line can be made from either a resistance point of view or a support point of view, right? Which we'll get into just in a moment after I explain what support and resistance is. Support and resistance is basically, as mentioned on the screen, right, is an expected pause. A resistance is an expected pause in a trend. A support is an expected pause in a downtrend. A resistance is an expected pause in an uptrend. A support is an expected pause in a downtrend. And why these are very, very important for your journey is, as mentioned if you take this chart as an example, in this uptrend, as mentioned, there's much more demand than selling, right? But in this level, as you can see, after the uptrend, there has been a stall, or price action has stopped going up and started to go sideways. That is basically a resistance area, right? If, for example, you take this as an example, price has come down here but has gone sideways, and you can potentially identify that as a support area. And when I mention support and resistances, right, it's a level, when it comes to resistance, it's a level where higher sell pressure exists, and a support is where higher demand exists. So we learn more intuitively by looking at a chart in the next episode to identify how to identify the support and resistances. But in the gist of it, or the basics, is where you probably expect demand to come into a counter or supply to come into a counter at a certain level, which can be which can be poised by either that level being a target for a lot of people, or that level being a psychologically rounded number, or that level being undervaluing or overvaluing a certain counter. There are multiple reasons for support and resistance levels to be to appear in a chart, but it's really hard for us to identify what's the exact reason. But knowing technical analysis will give you an idea of this support and resistance, and knowing these support and resistances will help you better risk manage using support and better and help you become better at taking profit by identifying these resistance levels. And as I mentioned in presentation here, right, how to identify support and resistance levels in a normal example of it would be identify areas where price has reversed direction in the past. So when you look at again technical analysis, in technical analysis, we want to make sure that we look at past price data to forecast future price action. So if in the past a certain counter has gotten reversed from an uptrend or a downtrend at a certain level, that is your first insight that that level can be a support and resistance level. And if there are multiple touch points on that certain support and resistance level, right, this will give you an idea of how strong the support or resistance level is, because there is a sort of a strength to each support and resistance level, where some can be very strong and some can be, okay. And right now, after identifying previous price action and you see, all right, in this area there is some price reversal, okay, in the future also there might be a price reversal in this area, so this I will identify as certain resistance level. All right, this counter in the past has gotten support from, let's say, rupees 20 multiple times, so intuitively in the future I could also expect price action to get supported at rupees 20 if price eventually comes down to that level. And that is the fundamental, or that is the thought process behind looking and knowing what happens at a support and resistance level. And as I mentioned, support and resistance levels can take two forms. It can either take a certain level where it can be from, for example, rupees 50 to 55, 40 to 45, whatever that is, based on your certain chart stocks pricing. Or it can also take the form of trend lines, and that is where I was going to get earlier, where even with trend lines, support and resistance levels can appear in the form of trend lines, where a price action or a stock's price can be supported vertically or slantedly to a downward trend line or upward trend line, which I'll show you in detail in our next episode, where not only, as mentioned, supply and resistance or support and resistance can be a level of a certain counter, it can also take the form of, I'd say, trend lines or charting patterns. And another important thing to keep in mind as we close off this episode is knowing that the more touches a certain support area or resistance area gets, whether it's a trend line or a area as mentioned, there is a likelihood that, for example, right, if I were to give you a quick overview, right, let's say in this starting counter, right, we have identified that this level is a resistance level, and a million quantity is put to ask here to be sold. The more times price action comes in and touches or comes into this resistance area, the more buyers absorb that sell pressure, right? So first time it might be a million, second time buyers might absorb half of that quantity, then there's only 500,000 stocks left to, or quantity left to be absorbed. And the third time, buyers might be able to absorb that quantity in overall and push higher. And this is why I mentioned the more touches that you might see on a certain support or resistance, there might be a likelihood that the support and resistance could be broken and price might continue its trend upwards or downwards. So there are a couple of things that you need to keep in mind when identifying support and resistance levels. And also you need to think of both sides of the coin, where you might, while you're expecting a certain area to be acting as support and resistance, you also need to think, okay, looking at the trading book, how much volume or or quantities traded in this certain resistance level, which I deem as a resistance, because again, resistance levels are kind of subjective again, where I might see a resistance level at this level, and you might see, sorry, I might see resistance level at this level, but you might not for some odd reason see. So resistance levels are subjective, even support levels, and the more visible it is, the more you can potentially think that it would act as support and resistance levels. But because investors like you, each and everyone will be seeing the same kind of pause in the trend at that certain level, and if that's the case, then you probably know that would be a more important resistance or support level to adhere to in your trading journey. And in the next episode, we'll actually dive deep into how to draw trend lines, how to identify support and resistance level, how to use a platform like TradingView to start your trading journey and start analyzing things. Um, but it's very important for you to understand the theory behind technical analysis and the basics behind technical analysis like support and resistances, which I've explained to you right now, so that you can make sure that when you're starting your actual technical analysis journey by analyzing charts, you have this fundamental or you have this theoretical knowledge to back your analysis. That's it from us for today, guys. Thank you for listening in, and hope to see you again on the next episode.